All right, testing, 1, 2, 3, testing, 1, 2, 3. The rain in Spain falls mainly on the plains, yeah? So good morning, Ohio, as they say in Japan. Good morning, how are you? Comment allez-vous? Time to get going, Forex traders. I want to do what? Well, it's a Monday, so we need to go through the calendar and look for the event risks of the week and the opportunities from volatility, right? We need to look at the commitment of traders report and look at the change in large positions of institutional investors like hedge funds in the marketplace, in particular with all the fundamentals that have changed. And lastly, I'd like to visit the junk bond market. Would you guys be interested in doing that? Talk a little bit about junk bonds, changes going on there? Yeah, why not, huh? It's what we do, yo. It's how we roll. Yep. Welcome to Forex.Today, our daily Forex trading strategy session. Let me remind you that trading Forex is risky and not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results. So please always stay small, stay humble, focus on the long term, and never risk money you cannot afford to lose. Hello. My name is Wayne McDonald. I'm the Chief FX Market Strategist for Traders Way, Forex broker with an ECN model that enters your trades directly into the interbanking system, quickly, smoothly, and affordably. We also offer you access to the energies market. Who's trading oil? Everybody. Metals, indices, and we're updating the binary platform for you. These sessions are every day, 7:30 in the morning, Monday through Thursday, here at Forex.Today, and every Friday at FX Street. Nice to have you. Today's session is held at Forex.Today. You're welcome to join us if you're watching a recording and you're like, man, this is cool. Well, why don't you join us? Just click on the register button. It's free, it's fast, it's lovely. It makes the world a better place. Brings peace and, hopefully one day peace and harmony to all mankind. Swing on by. If you miss the live stuff, we have recordings on the right-hand side, and we have a team of analysts that are stationed around the world that are watching the Forex market all day and all night, and when they see something interesting, they think about it, they ponder about it, they take screenshots, and they write their analysis, and they post it on the website for you for free because we love you. Oops. So here we are on our charts. I guess we should start with oil, right? As George W. Bush would say, oil. I'm an old man. Hey, pretty interesting stuff. You see, this is that big drop we measured about a month ago. Nice little retracement back to the 382. And what does a 382 predict as far as an extension? Yeah, 168. Yeah, 1618, and that's right here. Isn't that neat? So the basic Leonardo da Fibonacci analysis would suggest like this. And that's where we are right now. Doesn't mean it's the end of it, but it's just interesting. We start Monday morning right on the 1618. Pretty nice. So again, just a summary of that. If you're new to Fibonacci, here's the here's the peak. Here's the bottom. Retraced 382. That predicts a 1618. Now, what it's showing you is the downtrend is moving fast and aggressively, right? Now, if we had a retracement way up here, it's still a down move. It's just not as fast or aggressive, and the target would be here because it was such a big pullback. It's not likely to extend as much. And then way up here, if you did a 786, basically an 80% retracement, you're lucky to get back to break even or a little more if you can pick that up. Okay? But in this case, it's moving fast. It's there's a couple of ways to look at this. Everyone's getting out, and the other way of looking at it is there's no one that wants to get in. You can almost look at it like an illiquid market, right? Who in the world wants to buy oil? And as an amateur trader, you should always worry about that when you're trading against a fundamental move versus a technical move. You have to understand, who's going to join your trade with you? Because a lot of amateur traders will say, "Oh, it can't fall any farther." Oh yeah, it can. Watch it. Right? You watch it. It can do whatever it wants. So it's very fascinating stuff. We'll see how or when or if it changes. But when I first started trading Forex, there's a couple of interesting things that you might want to join me in the reminiscence with. Oil was at about $35 a barrel, and I watched the euro cross above parity with the dollar. So I don't know what, 10, 12, 13 years later, I'm right back where I was. Well, that was a good use of my time, right? How wonderful. So that's one thing that's going on. And then the other thing, let's talk about this big move. This is high yield corporate debt. U.S. high yield corporate bond index. HY, high yield. Right? All right. High yield bonds. Hey, somebody just faxed me 8 pages. That sounds like a virus waiting to happen, doesn't it? Delete that. All right. All right, so here we are, and this is the last month. Wow, huh? What does it all mean, Basil? Well, it seems to me the trend was slightly down and then pretty significantly down as of late. This is just the last 30 days, guys. What does it all mean? Well, what's a junk bond? Anybody? No, Chris, I wouldn't say bad bond and no return. That's, how about this? When a company needs to borrow money, it issues a bond. When an investor wants to lend that company money, it has to calculate it a few different things into the price or the interest rate in which they're willing to loan. One of the most important factors is the perceived risk. Okay? So what about a company that's a little bit speculative? Like, how about, let's say, an oil drilling company or an oil exploration company? They need to borrow, $20 million from you, and you're like, well, what if you don't find oil? You might not pay me back. You see? So what happens? They're going to have to pay more interest because it's, there's more risk associated with that. And that's why they call it a junk bond, because at some point, the interest is high and the value is low and you're taking on a lot of risk and so on and so forth. Well, what's happened over the last many years that the Fed has had interest rates at zero, a lot of people have been chasing yield, right? So the Fed is only paying 0.25%. What's Germany paying? Right? 0.25%, negative. It's hard to find yourself some easy money, right? There was a time there when you can pick up a Greek bond or an Italian bond or a Portuguese bond and make really nice money, but that was you only had that implied guarantee from the ECB, that wink, wink, nudge, nudge when Draghi said he'd do whatever it takes to support the euro. Well, you had to be quick on the draw and get in that, and then what happened was the equilibrium price of those bonds actually rose, right? So yields fell in Europe, and just like an arbitrage situation, the whole opportunity vanishes. So anyway, so what happened if you were not on that? What if you were just an average Joe and you were not a professional investor? Well, someone has come along and invented ETFs, exchange-traded funds, based on junk bonds, high-yield bonds. And so retail amateur traders could just call up the broker and say, buy me some ETF on high yield. Why would they want that? Well, their bonds everywhere else around the world were paying zero, and they were desperate for some sort of income, right? So a lot of money went into these junk bonds. In most cases, probably a really bad idea, right? You really kind of should know what's going on to get into that. That really should have been left for a financial intermediary to make those types of decisions, right? On whether a person should be in high yield bonds. But a lot of people, could just buy it, right? So anyways, a lot of retail money went into these ETFs to catch the high yield, and they were enjoying, for the last few years, they were enjoying some nice returns, and that's all gone now. And why? Well, the United States is starting to raise interest rates, or presumed to start raising interest rates on Wednesday, and you could probably find other places. People are kind of getting their money out of that and keeping their powder dry and getting ready for the next new and hopefully better and safer investments later. So money is coming out of that high-risk stuff, right? Because you're like, well, in 2 years, I could probably buy a 10-year T-note and earn 4%. So why do I need to earn 4% on this junk bond now, right? So everyone's getting out, but how about this? Okay, now hopefully you understand that, right? Interest rates are starting to rise, and therefore maybe you don't need to be in such junk bonds just to pick up a few extra, percentage points. But where is this money going to go? If you can figure that out, you'll be filthy stinking rich. Or at least you'll be successful, right? Remember, you should always be thinking cause and effect, cause and effect. All right, this is happening. Do you think this money is just going to, go to cash? Let's talk about behavioral finance. Do you think all these investors they're cashing out of these trades and they're just going to sit on cash now? Well, remember, cash still doesn't pay very much at the bank, even if the Fed raises interest rates up to a whopping 0.5%, and you keep your cash in your savings account. You were in this money so you could pick up 4%, right? So you got to do something with that. And it might be, I don't know, it might be good. I don't know. So think ahead, right? Think ahead. It's got to go somewhere. Where are they going to put their money? And this is really, now you're a professional investor in general. It doesn't even have to be a Forex trader. That you're watching this happen and you're like, all right, where's the next new thing? And then, of course, what if you had started shorting this a couple of weeks ago? Shorting, ETF high yield funds. Because people are not as desperate, or in the next few years will be much less desperate for yields, where they can pick up yields much more conservatively somewhere else with a different investment, right? Cool, huh? So yeah, Monday morning talking about junk bonds. Lovely. Let's go to Forex.Today. Forex.Today. Boom, shalakalaka. Ooh, we got a Aussie yen long trade. Let's check out YJ's post. Aussie yen has been in a downtrend for over a week now, but daily chart shows this pair is in an up channel and currently touching the bottom of the channel. Look at YJ. Very interesting. Cool. Yeah, I can see the concern in here. Top of the channel. Yeah. So in here, on a smaller time frame, we'd need to see a little bouncy bounce, huh? So that's a daily. That gives us a ton of time. What pivot point is this? This is S. So if this ends up being the low, I think what'll happen is we'll do R1, and that'll be the end of the week. But of course, that would be a technical move based on technical move. But we got a fundamental week with the Fed coming up. So yeah, we'll see. So one, wait for the double bottom. Oh, I love that. Yeah, I totally agree with that. So the way I would draw this is I would take this low and I'd drag it across. Yeah, that's a good setup, YJ. Good job. I like that. Buy. Yeah. Yeah. You got to get this to cycle down too, probably. And I think what it'll do is it'll diverge. So this will come down maybe a bit and then up, and this will keep diverging as we get bears out, and then it'll skyrocket. Pachow off of here. Yeah, I agree with that, YJ. Break through that. Playing off the dailies. Yeah, we'll see. My only concern is we got the move on the FOMC, and that can mess everything up technically, right? Yeah. All right, so let's move to the calendar. Beep, beep, beep. Filter this. New York. All right. Got some news. The meeting minutes. Should we read the meeting minutes? Aye. See, we should be worried about the Aussie-Kiwi relationship and New Zealand's cutting. But if it feels like Australia is stabilizing, right? Am I right? Doesn't it? We've had some good jobs reports and some other things. So I think we should really pay attention to the meeting minutes, right? And find out what they were talking about and how they feel and all that kind of stuff. So I think this is going to be an important one right off the bat. Could be overshadowed by the Fed stuff. But I really am interested in knowing if Aussie USD, for example, have printed a bottom. And we've hit the 70. We really seem to have held at 70. And we're making a cycle now. I don't know if you're looking at Aussie USD, but we're making a down cycle
Incoming
now
mail.
over the next, I don't know, day or two. But if we can kind of head up and get through the 4-hour 21 and breach through kind of the resistance area that we're now, again, I'm not showing the chart, but you just need to look at it. Could be interesting is all I'm saying. Probably not bullish today, but it'd be interesting if we end this week bullish. So meeting minutes is really going to help. I can't tell what's on their mind per se, but we can at least read what they discussed, and that's terribly important. So there's your homework for the day, guys. Actually, go to the RBA website and read the meeting minutes. Actually read them. Don't read a Wall Street Journal report on what was said. Don't read a Reuters press release. And one of the things you're going to find out is that they don't just talk about Australia. You're going to learn about the Fed policy. You're going to learn about China and various other things. Another thing to look for is worries about their housing. Okay, if they talked about the value of the Aussie dollar, these are all hugely important things. Okay, and then UK CPI, don't worry about it. They don't have any inflation. Here, worry about the monetary policy meeting minutes, right? Right? Zoo sentiment, don't worry. It's terrible. Don't worry about it. Right? Manufacturing sales in Canada, nobody's buying equipment. Don't worry about it. Who's going to buy equipment? Right? All right. Then we go to CPI, and this is Tuesday, right? Tuesday morning, tomorrow, I guess. Tuesday morning, and CPI, yeah. Normally that's interesting, especially core year over year. Look at that. Look at the difference between headline and core. Just ridiculous. And it used to be the other way around. It's funny how this is now core is super high. Normally this is really important stuff. But nobody cares this week, right? Like, we'll get to it if you don't know. Okay, Bank of Canada, Pelosi is speaking. That will be interesting. That will be interesting. Does it say anything on there? Blah, blah, blah. All right, tells us who he is. All right, well, maybe there's an opportunity for Governor Pelosi to say he's going to save Canada. I think, I don't know. It's too bad Canada can't just hedge, right? Like a corporation. I guess it could, right? What's the chances of Canada pegging the Canadian dollar? 0. Yeah, Canada's in a world of hurt, but the fall in the Canadian dollar has just been fantastically profitable. Anybody here just making pips hand over fist on the fall in the Canadian dollar? Anybody? Good. Guy is right on. Artem, yep. Right on. That's what you're supposed to do. Now, if you're Canadian, if you're in Canada, you need to be hedging, my friend. I mean, it's kind of what your job is, right? Horace? You guys, this should be your job. It should be your number one thing, right? If you do one thing well, if you're in Canada, you should be trading the Canadian dollar very well. Just it's sort of like a bare minimum expectation, right? It's your thing. Well, yeah, pay attention to oil, right? That's what it comes down to, right, Guy? But, so anyways, Pelosi could say something. I don't know what he could say that'll help, but he might say something. So pay attention. France, Germany, UK, not, all of this isn't going to matter, right? What matters this week? Anybody? Anybody have a guess? Yeah. Yeah. How about the Fed interest rate decision? That's what I'm saying. Like these things don't matter. What, going into the Fed meeting? You think you're going to have a market mover before the Fed meeting? Oh well, look at flash PMI out of Germany or France, right? Did you see flash PMI out of France? Holy moly, right? I mean, it's you're not going to overshadow the interest rate decision in the United States, right? So don't expect a lot of volume and volatility in the European trading going up to this statement. Like, what new money is going to come in, right? Okay, you might get some like retail money, but you're not going to get big money. You're not going to get hedge fund money. You're not going to get central bank money. You're not going to get multinational conglomerate money. Just us chickens, right? So just be careful here. So, yeah, there's going to be a press conference. Wow, what is Grandma Yellen going to say? Now, this is interesting. Okay, we know the decision is what, 90% that they're going to raise interest rates to a 0.25%. Okay, cool. Fine. Yeah, okay. But the question now is, how fast? At the end of 2016, 1 year from now, what are interest rates going to be? 1%? Yeah, that seems reasonable to me. The more clarity she gives there, the better. And if she says, yeah, our 1 year target is going to be blah, 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 and just spells it out, or, I don't think she'll say every other meeting, but I think what we'll find is every other meeting is going to be the important one, right? And we could see that where they raise, then the next one they hold, the next one they raise, the next one they hold. And there's 8 meetings a year, so that gives you 1% at the end of 8 meetings. Okay, that would be cool. And by the way, Australia used to do that all the time. Is that right, Cream? Yeah, well, see, I don't guess. I mean, that might be a good guess. Not my call. Right? So I'm going off what's likely, and that's more likely than not. The rest is, I don't know. We'll see. I learn as I go, right? Add more information, gather an intelligence, formulate a strategy. I even teach my children that. Okay. Come on, calendar. It's not giving me can't see these things. All right. So new GDP out of New Zealand. All right. Well, yeah. What's the interest rate in New Zealand? Okay. And inflation, according to, or GDP, 2.4. That would be a problem, right? Yeah, Luis, you're right. So my book is based on a lot of the art of war and stuff like that. So one of the things I used to talk about is trade planning, and a general who, right, a general who plans. Oh, I can't think of the words, right? But anyways, a general that sits and plans will probably win because many plans are made. All right. So yeah, well, this is a problem, especially what if GDP for New Zealand comes out 2.1, 1.9? What if? Would interest rates need to be 2.5% if GDP is only 1.9%? Right? So that's the questions we need to be asking if you're trading the Kiwi. Because a bad GDP is going to give creed to the idea of further interest rate cuts in New Zealand, which means you should be a Kiwi bear. Get on it and trade it, dump it, right? Okay. IFO, I think we'll still be trading the fallout up here on the US dollar. So for example, if US dollar returns to strength as traders get back in, probably not on the interest rate decision because that's already priced in. But if Grandma Yellen says something that gives us an idea of how much and how fast, and that is interpreted as bullish, then the dollar gets strong. So if that happens, and then it's followed up a couple hours later, New Zealand has a terrible headline GDP number, guess what? You're short Kiwi dollar. Right? So put it together. We're talking about it on Monday, about Wednesday night, Thursday morning kind of stuff. Okay? If that happens and that happens, then you got yourself a trade. Okay? German IFO, UK retail sales. You know, all of this stuff I think is just going to be the fallout after FOMC. I think if dollar's strong or dollar's weak, that's what's going to happen. IFO is important. UK retail sales, I mean, yeah, just in this context, end of the year flows, FOMC stuff, I think are just, people are going to do what they wanted to do, and none of this is really going to stop it. Then we get like the Philly Fed weekly unemployment claims, nah. But I'm thinking though, like the Friday move is now enough time where there's been the aftermath, and we can take a deep breath going into the weekend. Bank of Japan press conference. Okay, all these press conferences are very important, guys. You know, more than, I'm sorry, more than French, PMI, right? And then, more Canadian news. Well, I'll tell you what, if we have a strong dollar, Canada's CPI can't be that great, right? What if it goes negative month over month? Well, now you got to trade, right? So it's more like what's likely to happen, and I don't see a good, strong, compelling reason why Canadian CPI should be high, right? Prices are probably falling. Right? Just because I'm sure demand. At some point, the Canadian dollar will get so weak that then their purchasing power is going to diminish. But we're not going to see that in the short run. So if this is a bad number and that weakens the Canadian dollar, and if this press conference for the FOMC gives dollar strength, you could have a perfect storm Friday morning and the week happy. Even if you're Canadian, at least you can do your job and not lose money, right? All right, so let's see. We started the morning with junk bonds. Then we've done event risk. How about we do a commitment of traders report? Okay, looks like euro dollar jumped from 105 to 19. That's interesting, huh? By the way, let me quickly ask, is anybody unfamiliar with the Commitment of Traders report? We've had quite a few new people register. I'd like to ask, and then I'll be happy to fill in the blanks. It's kind of like why I'm here. Now, how did you guys hear about the webinars? Google, YouTube, FX Street. Wow, that's like the Holy Trinity, right? Yeah, the three horsemen. Dust in the wind. All right. So yeah, let's talk about this. In the United States of America, if you buy a futures contract, it's recorded by the exchange in which you're trading your futures contract. Because that's what an exchange does. There's a party, there's a counterparty, and the exchange is in the middle, right? And so that transaction is recorded. Nice, good. And so somebody is holding a contract. Now, if your positions are large enough, you're actually required to report this to the Commodities Futures Trading Commission, otherwise known as the CFTC. Because the government wants to know when the market is heavily weighted one way or the other, because that's risk for the market. Case in point, carry trade collapses and unwinds and stuff, right? So, all these positions are recorded. Also, the government says, hey, if you're legitimately hedging your risk, and that's what this market's designed for, right? To transfer risk from those that don't want it to those that are willing to assume it. So if you make cereal and you need corn and wheat, right, you're worried about in the future those prices will go up. Well, you don't want those prices to go up. Okay, so you want today's price in the future. And if it goes up, you'd rather pay today's lower price than the future's higher price. So you go to the futures market, you buy futures contracts. So if prices do go up, you'll make money on your futures contracts, which just offset your loss in the cash market. And for you, in the future, you get today's price. Your risk is hedged. Now the government says, all right, that's a legitimate thing, because if you can hedge that risk, then that's good for the economy in general. So like if you can also hedge exchange rate risk, if you could also hedge interest rate risk, and all that kind of stuff, then throughout the economy, businesses will borrow money, hedge out any risk that they're worried about, and get projects done, build factories, do this, do that. So it's good for everyone on the long run if that risk can be hedged. Well, who's going to take the other side of that risk? Well, someone will say, you know what? I don't think, wheat prices are going up. I don't think corn prices are going up. Well, a cereal producer might not even care. They're just worried that what if it goes up? Then they're guaranteed to lose money, even if that's unlikely. They're still going to lose money, right? So they might just hedge just because they hedge everything. They always hedge. Well, so someone will show up and say, well, those dum-dums, they're hedging because they think corn prices might go up? That's stupid. Let me in on that. And there's the seller, and they'll assume the risk because they'll make money, right, if the prices fall. Cool. So it's a transfer of risk from those that don't want the risk to someone that are willing to take it. Now the hedgers, the government wants to know about the hedgers. So they say, tell us that you're a hedger. And the private companies say, well, we don't have to tell you anything if we don't want to. And then they say, all right, well, how about this? We won't tax you on it if you tell us you're a hedger. Okay, we're hedgers. All of a sudden, everyone's like, we're hedgers, we're a legitimate hedger. Good. So now the government can look at the data, the flow, right? The money flow, the large positions in the market, and all that kind of stuff. And they can figure out who's holding the contracts, right? So the first one, you know, is that they're bona fide hedgers. So you can subtract that from the data now. I don't want to look at hedging, right? So we're looking at non-hedgers, as you can see here. I don't want to look at hedgers because they're long, because they think but it's not that they think price go up. They're just like, if price goes up, we don't want to lose money. All right, fine. So that information wouldn't be helpful because it just clouds up the data, right? So now we got total volume minus hedgers. So now we got total volume of contracts, and the government then goes in and says, all right, because now we know these are speculators, they're not hedgers, so now they're only speculators. Then the government says, if your positions are large, and I forget how much it is, but it's big, right? You're a big player now. You're not a retail Forex trader. It's, I don't know, it's 10 million, it's $100 million. I don't know what it is. It's big money, all right? I've forgotten. It's on my Series 3 test somewhere. But whatever, it's big is all that matters, right? So if you have a big position, you're required to report it to the CFTC. Cool, this is neat, because now we could take them out of the picture, and what's left? We don't have hedgers. We don't have large institutional positions. What's left in the data? Small speculative traders, right? Dumb money. No, they're all speculators. Damn it, when we removed bona fide hedgers, everyone left were speculators. So now there's large speculators that have reportable positions, and then there's the others, small speculators with non-reportable positions. You see what I mean? So you can just keep removing what you know, and you end up what's left, and then you can, what's left is everybody else. You and me, basically, right? Dumb money is another way of looking at it. So, but they're not required to report, so, right? So anyways, that's removed. So what we're looking at here is large, speculative, right, non-hedging, open positions. This is where the hedge funds live. Isn't this nice? And this isn't opinion, guys. This is money in the market on Tuesday. Now, I know it's Monday morning, but this data was captured as of Tuesday, and then it was released Friday afternoon after close. So it's new to us, okay? So it's as fresh as you can get it. Now, just to show you it's current, the red line here, okay, this line here, this is the value of the Euro USD. Boop. And what we're looking at is the difference of these little dots. Well, you can see the dot was dramatic. Okay, Euro USD rose about 400 or 500 pips week over week. Very dramatic compared to what a normal week is about. And so we know that's what happened last week, right? So we know this is good data. That's just the price, Euro USD. You can see it was about 105, went up to about 109. Okay, cool. So what is all these other things? We want to look at, first of all, oops, I keep clicking the wrong button. Hang on. The gray line are long positions. And this is something I talked about when this price was skyrocketing. I talked about this, that you would see no change in long positions. So let me just repeat what I said back then and what we see now, right? The euro dollar went up 500 pips. Okay? Everybody following me? We see that here. You were there. But nobody bought it. Nobody bought the euro USD. Statistically speaking. Well, certainly no professionals. Now, maybe a bunch of us chickens bought it on short-term, stuff, but no professional investor bought it. None. Nobody bought it. I said it when it was happening. Nobody bought it, and it went up 500 pips. Okay, and a bit of a decline here shows actual, right, people getting out of their shorts. Wow. Another thing that I think is interesting is there wasn't a dramatic change in the amount of shorts. It's almost like the market is still heavily net short. Look at the change in positions week over week. So I'm going to add to this guesswork a little bit that a lot of amateur retail traders were in these moves. Now, of course, if no one was buying and it jumped, then a lot of people got wiped out for loss. Okay? And then anyone that did buy, they were very small traders. They were only holding it, less than a week, right? So on and so forth. All right, so Rob asks the good question, of course. How could price rise without buyers? Because going into that news event, everyone was a seller. So the market is bearish. They're short. They're actually in short positions. And when they take profit or get stopped out, depending wherever their stop is, right? Whatever, they get out of the trade. Rob, how does your broker get you out of a trade? Right? If you're short, how do they actually, what's the mechanical thing? What's the mechanical process of getting you out of your trade? They have to offset your short. Okay? Is there a new position in the market though, Rob? No. It's offset. So you were short, which means this line, if it had your trade on it, would be going up, because that means there are more short positions. Okay? And then when you get out of the trade, that trade comes out. It's not added as a long. They add a long, and that cancels out your short. One less position in the market. But it's still a buy order. They still bought. It's just not a buy position. So now imagine, stop losses being hit, and people getting out of their short positions that they've been in for weeks and even months. And you get this cascading effect where more and more people are just simply getting out. No one is getting in, they're only getting out. And the rest, though, okay, the rest could just be very, very short-term, dumb money, short-term speculative traders, right? Because we see very few people actually got out of those short. Nobody actually longed as far as institutional investors, right? Think of that, guys. A few people got out, nobody went long. Either this needs to go up more and scare out more professionals, or the professionals are just going to stay short and this is going to go down. Maybe not this week, maybe not this month, but there's almost no change. Okay? So if you look down in here now, this little black line, this is the change in net positions. That's where you add up all the longs to the shorts, right? Or subtract all the shorts from the longs or whatever. And if it's if it's a positive number, you're going to be above the zero line. If it's a negative number, you're below. So if you're below if you're below this zero line, then the market is net bearish, net short. And you can see there's just a slight change, just a tiny little change. Price dramatically moved, but almost no change in positions by large institutional investors. Huh. A lot of retail noise, no institutional change. Almost none at all. How interesting is that, huh? So my play last week was let Euro USD rise up to like 112.50 and then short up there. Well, I haven't got that, but I'm going to keep my eyes on things. Okay, pig. Okay. What's the trend here? Net short, but less and less so. Isn't it interesting we have a divergence? Price is falling, less institutional investors are short. How about this? There are more buyers and less sellers. Yet, price is falling. Whale oil B. MR fish. Okay? Isn't that interesting? So if you're a bull, or how about this? If you're just trading the British pound, you got to pay attention to whether you're bullish or bearish. And you better pick your lines. I mean, if you're a bull, you better buy at hardcore support. If you're a bear, you better sell at hardcore resistance. Okay? And right now, we're moving back to neutrality, back to the zero line. Seems to me, you're a candle in the wind. If Euro works its way down, this will become more attractive again, right? Europeans moving their money back to London. So anyways, let's pay attention to this. It's not a clear setup, right? You see? It's just, I mean, you see how there's, generally speaking, let's say over the last 2 or 3 weeks, more bulls and more bears, generally speaking. I mean, it's just more trading volume. Not the clearest of move, except it's slightly bullish, except price is falling. So just, take it day by day, I suppose, and make your entries good. Okay? Right? It's not quite neutral, but it's working its way to neutrality. Yen yen. Okay. People are tired. We sat on this moving sideways for 2 months, 3 months. Seemed like forever, actually. So where are we now? This shows us about 123. Oops. I meant to do the circle. There we go. This shows that it's about 123. We're down here now. 121 and a half, 122, 120, 120. We're about here now. I'm thinking about buying it around 120, 120.50, but we're almost there, almost now, right? 119.50 could be cool. Okay. Now remember, I don't buy it blindly because that's silly. But I know where I want to pay attention. right? Less and less and less and less and less and less and less people short. Okay. According to this, as of Tuesday, nobody's buying the yen. So this has to be mostly dollar weakness, not yen strength, right? So like USD yen is falling. Is it yen strength? Well, these are the buyers. Does that look like confident buyers to you? No. So remember, this is a futures contract priced in dollars for the Japanese yen, right? So, all right, Swissy. Whoa! Look at that, huh? A lot of offsets. Okay. Nobody buying, right? Less buyers, less sellers. Almost no change in position, though, when you net it all out. Aussie. Okay. Dramatically less people shorting. You see? And we've been getting all this good data now over the last couple of months. 2 months in a row with much better than expected jobs reports. That kind of stuff. Starting, we're getting rid of the bears. But look it. Nobody's buying it. So this is telling us that we shouldn't really expect a dramatic increase in the value of the Australian dollar. But the bears are, we're losing a lot of bears. Right? So we'll see what happens. If you want to look at history, these are the net positions rising, and this is the value of the Aussie dollar in that period. But you need buyers, right? Well, in this last move, what happened was almost no additional buyers, but we had a lot of bears get out. So that's the beginning. So working our way back to neutrality on Aussie, but that's a change. I mean, all right. Cool, man. We hit 70 and stopped. Cool, man. That's cool. Kiwi. They've cut interest rates since then, and that's not reflected here, so I'll just skip it because obviously that's important. And kitty cad. A little bit of longs came in, but dramatically more shorts. Okay. So looking at things technically, money flowing out of high risk, high yield stuff because of the Fed. We have oil collapsing. Very interesting stuff. This is a 4-hour chart. Can you figure out what the trend is? So as you make highs, it's your job to keep marking them for new opportunities. So for example, let's say the Fed meeting's a disappointment, US dollar's weak for a while, and we do this, and next Friday we're down here. 1 week from today we're down here. Pachow! But the only problem is it'll be Christmas time, right? But that's how you trade things technically. Okay, so this is just your job. So if I zoom back in now, okay, just like I teach, up, down to the moving averages, up, probably down to the moving averages, and up, all else being equal. See how we already touched the 5 EMA and we were supposed to skyrocket? What this feels like is it wants to come down to the 21. All I'm talking about is this area here. Okay. So we'll probably get a situation like this again. Down to the 21, long and gone. So, cool. Well, tomorrow we're going to focus exclusively on technical analysis. Who's going to be here tomorrow? Okay. So if you're on Forex.Today, please leave a comment for our analyst team. They work hard at what they do, and I think they do a fabulous job. Leave a comment, huh? And if you're watching this on YouTube, subscribe, leave a comment there. So I'll see you tomorrow. And again, we're getting pretty close to the end of the year. I still haven't taken a day off, but I guess they'll have to force me out for the holidays. But I'll be here tomorrow like I'm here every day. Don't want to let you down. You're my sweet baby. Peace on earth. May the pips be with you. May your profits be above average. And I'll see you tomorrow, huh? Cheers.